Well, let's start off with the sense you're making of some of the activity we're seeing on the market scene today, where liquidity issues are still driving, but where we're looking at a bit of a pullback today, and some saying it's simply been a case of too much too soon thus far.
Yes, Alishia, I think that's quite right. You're seeing global weakness across all markets, but really to call it weakness, down 0.5% or down 1% is not a lot given the tremendous up moves we've had over the past few weeks. And really we're holding on to a lot of our gains. And while this liquidity issue is causing a little bit of nerves, it's not really material at this stage.
Despite the negativity we've seen filtered through to the resources 20 sector and commodity prices in general, as you say, it hasn't been that extreme. Of course, with the prospects for economic recovery gleaming through, with much of the good news priced into a lot of these commodity prices already, though, how much more room do you see for commodity prices and them having to run moving forward?
Well, you know, on one hand, it feels like they've done way too much too soon. And on the other hand, you get the likes of Cazenove this morning upgraded its outlook for iron ore prices this year. They reckon they could increase by another 40% for the year. So I think on one hand, it does feel frothy. It does feel like it's overdone. But the momentum is very powerful. The cash on the sidelines is so much and so significant that I do believe this can continue for longer than people think.
Of course, as I was saying earlier, we heard big news out of Asia this morning, and that being that the Central Bank of China unexpectedly raised rates at a 3-month bill auction. Traders saying that this could possibly be a signal of tighter monetary policy moving forward. It's certainly affecting the industrial metals today. How much of a concern has this move been for the markets?
It has been. It's probably an excuse for a little bit of profit taking. I don't think it's a real concern at this stage. We know a lot of China's growth last year has been driven by their massive lending and massive credit growth, and they do need to keep an eye on it. But right now the primary sort of focus is on the bigger picture of stimulus packages around the world as a collective, and as it stands, they seem to be a long way off from any meaningful withdrawal of current quantitative easing and stimulus packages.
In fact, out of the US Fed meeting yesterday, minutes suggest that the US might need fresh stimulus moving forward.
Yes, I think that just reiterates the point and the comfort that the market has, that to the extent that there's any stimulus needed in these markets, they will be provided, and the market will continue to look for that whenever it's needed. Yeah. I don't think there's a fear of a short-term withdrawal.
Of course, key to all of this will be US employment data tomorrow, so we wait with bated breath for those to come to the fore. In the meantime, let's take a look at the strategy you're adopting for the year ahead. I mean, how are you playing the game until fundamentals become supportive of some of the market exuberance we've seen?
Yes, I think the numbers is critical. As you said, the jobs data coming out tomorrow, there's an expectation or a possibility that it will be flat to even maybe slightly on the positive side, which will really support the sentiment that we've turned the corner, we've bottomed out, and we're moving in the right direction. Obviously, we need to see positive job creation as the next step. But I think the way to play the market at the moment is there's a lot of momentum in one direction, and it doesn't really pay to swim against the tide and to run with the momentum, but keep a little bit of a cautious note. I think it can carry on for longer than people think. So for my part, I'm just going to go with the flow. You can feel where the strength is, you can feel where the momentum is, and just be aware of signs of a change in underlying sentiment that will be led by a lack of economic fundamentals.
There's a bit of a contrary view out there, Grant, where some have suggested looking at companies that have underperformed. I mean, if we look within the resources space, for example, we saw Kumba Iron Ore returning 106% last year, Sasol and ArcelorMittal in the meantime returning 6% and 13% respectively. What do you think of that strategy, diversifying your risk going down that route?
I think it makes a lot of sense. As the market seems to run further and further with the fundamentals lagging, your value picking, you're looking for where value lies is far more critical, and it'll offer you a lot more protection should there be some sort of pullback. So that is definitely the right strategy. One, from a relative value point of view, it's critical in fact. And even looking outside of the sectors at some of the defensive plays would also make a lot of sense at the moment.
Just taking a look at outside of the resources arena, we know that resources have stolen a lot of the attention so far this year, what we've experienced thus far. On the opposite end of that continuum sits some of the telecoms players. Is this a matter of sector switching right now, or just a case of so much focus being on resources?
I think at the moment, I think people are saying if you're going to be anywhere in this market, you've got to be in the resources. That's where the action is. If you're not in that space, you will underperform the market, and I think people are chasing those returns. It does seem to be a broad-based sell-off in the telecom sectors, and we're seeing it even globally. There was a downgrade of Deutsche Telekom just the other day, and all of our telecoms are have been sold off fairly hard over the past week or two.
How are you viewing them moving forward, Grant? Will you be indulging in any of these? MTN, Vodacom, Telkom, of course, all three of these players locally have had news surrounding them just this week.
Yes, I think from my point of view, from an investment point of view, I would look at the long-term fundamentals and where the value is. And I do believe something like MTN really does offer value at these levels. I wouldn't be uncomfortable buying it at these levels. Some of the resource stocks are starting to look a little bit uncomfortable for me, so I would trade those with a short-term point of view. I would be a buyer, but I don't think I'd take a long-term holding perspective on those. Something like Telecom looks like it adds value.
Let's take a look at outside of the top 40, some of the smaller caps. Is that an area that you'd be playing in this year, or is it risky bets to be taking?
I think the small caps are risky. They're the ones that are most vulnerable to cash flow crunches and liquidity squeezes. And they really are a bull market play. As we have seen, we have been in somewhat of a bull market for the past 8 to 10 months. Really, if this bull market sustains itself, I think there's a huge value to be unlocked in the small caps, but they hold the commensurate risk with that value unlock.
With some of the optimism slowly starting to filter through to the markets, we heard commentary out of the JSE today saying that while new listings fell by more than half last year, prospects for this year are looking brighter as the global economy recovers. How do you see the market reacting to new listings, Grant?
I think a bull market is always receptive to new listings. So as long as people are feeling positive and confident about the economy and the markets, I think they'll welcome new listings as an opportunity to make some money and to get involved in new companies. But as soon as there's a bit of nerves around and we're involved in some sort of retracement in the market, I don't think the new listings will be that successful.